Well, I think we exposed a structural issue in the market, and I think we kind of stretched the fabric on the upside and the downside in a very short period of time. I think it created a big scramble to adjust sort of value at risk for a lot of strategies and portfolios. And I have to say that some of this is very typical, this price action we're having now. It's trying to gradually claw back some of the gains that it had given up.
Searching for equilibrium here.
Yeah, there was a component of it that had to be technical, right?
Yeah.
But I would look forward a little bit and start to apply some thinking toward what does this higher volatility actually mean? Is the market sending us another message?
And is it, do you think?
I think there is a message in that we're beginning to see higher volatility in interest rates. And that's really the center of gravity when it comes to pricing assets.
Yeah.
So that was occurring for a couple of months, started in early September. So that troubled through the market. And I think what we have to watch for now is a couple of other things related to stocks. First quarter earnings comparisons year over year are going to be difficult. We had a very strong quarter in the first quarter 17. Here comes the 18 numbers. The market will smell that before it happens. Yeah. So I think we've already seen some noise in the numbers, and I think that's likely to continue.
Chris, I had to reread your notes. I thought you were talking about automobiles, but you said this is really kind of like torque. What do you mean?
Well, I mean, this perhaps is a new term, but a torque correction is one that includes velocity, the speed of the decline, force, which is the magnitude of the decline, and then ultimately what happens during it, and that's rotation. And we haven't seen significant portfolio rotation in quite a long period of time. And with the last time we went through an episode that seemed similar to this was the mid-cycle correction. So it's been a few years before that, and what we're pointing to is just 2 years ago, we had significant fears of deflation when oil collapsed twice.
Sure.
And that's the last time we had a 10% correction. All of a sudden, 2 years later, now we're all of a sudden worried about significant inflation to come. So the point here is that this is a torque correction. It's technical in nature, but it does have legs.
Chris, I know everyone's going to be watching for that consumer price index number tomorrow morning. Do you think that it's legitimate for the markets to worry about inflation then, or no?
No question about it. I think the one thing that everyone should always worry about is the level of price stability, and one of which measures is inflation. But to suggest that we're going to all of a sudden start to switch on a dime to an inflationary consequence, I think is a little premature. I would say this, though, Kelly, to your point, we're going to get data points, perhaps Wednesday, that look a little dicey as it relates to, yes, the speed of inflation's coming, but we're going to also get data points because of secular moves, technology, other things, demographics that will push that level of price instability down over the course of months. We are in a regime shift, though. We are there, and portfolios are going to have to reposition themselves.
Liam, a lot of headlines also suggested that this was about interest rates and the rate of increase of the 10-year especially. And you even have some Fed officials who are still talking tough. Right. Even with this volatility, they're saying we still have to stay the course and raise rates this year. Is that good or bad for the market?
I think it's going to create some additional friction. It is a concern. What I'm interested in is yes, the rate of increase in rates has risen, but we've never had this much debt in the system. And we've never had a Fed that's been so involved in markets now pulling out, withdrawing. So there goes a $25 billion, on the sell side coming, and $75 billion more to fund the deficit. This creates a very interesting situation, given the fact that a lot of banks and traders in the markets in interest rate futures have stepped away because of the Volcker rule and the lack of prop trading. So there are difficulties now when it comes to liquidity in certain situations. So I'm concerned about interest rates, and I'm concerned that expectations are just, hey, what just happened is behind us. Let's go back to the normal. That seems to be consensus. That makes me a little bit nervous.
That was too.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.